moving back to how gold could bottom, it could also come down here, I think to 3,900, 3,850, something like that. So that's a level to keep in mind for a final low. And so given that scenario, I would expect silver to come down here to 55 or 56. When gold makes its next move and the stock market has its next bear market, you're going to see gold go to 10,000 during that move and eventually much higher after that. And so we have to understand what we're coming to. This is a significant low in the gold market, the silver market as well, and also for the stocks. And it's going to be an incredible buying opportunity.
So it gives us a general zone of where we could go to on gold. And again, this is kind of where I'm getting my general price target. This is around 3,500. This would be a pierce of 3,500, just like we pierced here. It tends to pierce because panic will hit, and it needs to still come down and flush those weak hands out. I know that's not what we all want to hear. Listen, I would love gold to be at 10,000, my multi-year out target. We look at silver real quick. It's obvious here just because it's a high pivot and a high pivot. Now, do I think it stops there? No, at some point I think it has to go back to 50.
Gold and silver may still need one more shakeout before the next major advance. The stronger opportunity arises after weak holders are forced out and sentiment becomes deeply oversold. Jordan Roy-Byrne, a respected precious metals analyst known for his cycle and chart-based market work, and Gareth Soloway, a veteran technical trader known for mapping key support and resistance levels, argue that the current pullback should be viewed as part of a larger bullish setup rather than the end of the metals trend. The near-term risk remains real because rising real rates, a flattening yield curve, and gold's recent link with risk assets still point to pressure. Gold could retest the $3,900 to $3,850 area, and a panic flush toward $3,500 remains possible if selling accelerates. Silver could also slip toward $55, $54, or even the old $50 breakout zone. That weakness, however, would likely create a stronger long-term entry before gold eventually targets $10,000 during the next major move. The better plan is to respect support levels while keeping focus on the much larger cycle that starts after this reset. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
This is the problem right now for gold and silver. This is what's driving a bit more selling in gold and silver. And that's, as I have said in recent videos, the fundamentals are still bearish. We have real interest rates here. They are still rising. We have the yield curve here, which is flattening. So when the yield curve is declining, they call that flattening. That is bearish for gold and silver. And so it's doing that because we see the 2-year yield, which the Fed follows, is stronger than the 10-year yield. Now, what gold needs is the 2-year yield to peak and roll over, or the 10-year yield to move up like this and rise faster than the 2-year yield. So that's the bugaboo for gold right now, a lot more so than sentiment and technicals. But moving on, just another quick comment on fundamentals here. And I want to show, and I'll talk about this more in another video in the future, but I want to show the 2-year and the Fed funds rate here and how gold has reacted recently to when they start hiking rates. Now we can go back here, and now these vertical lines here mark the start of hiking regimes. So the last one here was at 2022, and that's exactly when, or right about when, gold peaked and then had a 20% decline. Now, if we go back farther than that, you had this in the beginning of 2016, or maybe it was December 2015, where they just did one hike and then they waited for another year before resuming hikes. But what's interesting is both these points essentially mark bottoms. And it's the same thing here in 2004. They started a new cycle, and this actually marked a bottom. Also, similarly, 1999, they started hiking at mark to bottom. So the key right now for gold with respect to the Fed, if they're going to hike or if they're not, and that is, if they hike but the gold price is down way off its highs like it is now, that could actually mark a bottom, okay? But if gold rallies back like this, then they decide to hike, then gold would come down like that, as it did in 2022. So again, we'll get more on that in another video. But that's your fundamental story for now. It's not yet bullish for gold, but the reality is gold and silver can bottom and rebound before the fundamentals really turn bullish. When they turn bullish, that's what takes the rebound from a fledgling rebound to the point where gold can rally back to the high and eventually break to a new high. Okay, now let's get to technicals. Here is our gold correction analog chart. Now we plot the 1973 and 2006 corrections in gold on the same scale as the current correction. Why do we do that? Well, these corrections were the first big correction after a major breakout in gold. 3 major breakouts in gold, 3 major corrections. And what do you know? The black here is the current correction. Look at how well it's followed the other two. In the last 2 or 3 months, they've come down like this. In 1973, this was the bottom, about 39.50. Now, the bottom in 2006 was right about here, call it 41.50 or so. So based on this analog, this move down like this, I think could be setting up a final bottom, okay? So look for that over the coming weeks. And speaking about how the market could bottom, if you watched my video last week, I talked about it here. To look for one of these types of patterns with respect to how gold could bottom over the coming weeks. Now, I think we can rule this one out where you have a hard move down, you have a rally, and then it goes sideways before the rebound gains traction. I think we can rule that out now. I don't think we're going to see that type of move like that. So to me, it looks like it's going to be one of these two, this or this. Now, because the fundamentals are bearish right now, and one point I want to make, a good percentage of that has been discounted already. This move down in gold has actually already discounted one rate hike, in my opinion, but I digress. So moving back to how gold could bottom, these are the options where you get a double bottom like this, where it comes down like that, or you see something like this where it's a false new low, okay? It comes down like that, and then you get a move like that. It's a false new low. So I think we have to be on guard for something like this, a false new low. And so support for that, you do have great support here at the recent low at 40.50. That's also the 38% retracement or around there for the 22 and 23 lows. It could also come down here, I think to 3,900, 38.50, something like that. So that's a level to keep in mind for a final low in gold. And so where would that put silver? At this point, this is a gold silver ratio here, and it's starting to turn up. So if we see more selling in both gold and silver, we'll probably see gold outperform silver. And so given that scenario, I would expect silver to come down here to 55 or 56. Okay.
The bottom line for me is that as someone who's holding long-term positions in gold and silver, I still want to buy more. I just want to wait for the appropriate level. I mean, do I want to buy at 4,200 here, or do I want to buy at 3,500, 36? Now, it's not to say that if you have no gold, it's not okay to just buy a little bit here. But for me, at least, since I already have gold holdings, I'm going to wait for that lower level. And if I miss it, I miss it. Like, it's not the end of the world. Again, as long as you have that already allocation, right? It's just a matter of, well, where do I think it's a really no-brainer buy to buy more? So as we continue in the charts, the idea here is that, again, whether we bounce up a little bit more, maybe to 43, 4,400, maybe even retest here, at some point, we're probably going down to this lower level. If we zoom out here and we drag our parallel out even further, right? Well, what do we have? Well, let's just say we bounce around, we get a little bit more of a bounce, and then we come down, we break down. You're looking at like late July, August at earliest that will probably hit this level. What's interesting about that is you have a confluence of technical supports right here, right? So that's number one. And then obviously this band right here. So it gives us a general zone of where we could go to on gold. And again, this is kind of where I'm getting my general price target. This is around 3,500. This would be a pierce of 3,500, just like we pierced here. It tends to pierce because panic will hit. Now, one of the key factors here that I want to make sure we understand is that if you looked at last week in gold, right, the stock market fell early in the week, gold fell. The stock market bounced late in the week, gold rallied. That's a problem. And you might say, well, you know, if you're new to gold, you might say, well, why is that a problem? And the problem is that gold has always been, for literally hundreds of years, thousands of years, it's been a safe haven asset. So it generally doesn't trade with the stock market. Usually it trades inverse, except for a few select times in history, like when COVID panic hit and people thought the world was ending, and then everything fell. But then gold really quickly recovered and rallied to the upside, making short-term highs, right? So the idea is that the mere fact it's trading with risk assets, that continues to show me there's too much speculative money in gold, and it needs to still come down and flush those weak hands out. I know that's not what we all want to hear. Listen, I would love gold to be at 10,000, my multi-year out target, but I'm a realist too, right? And kind of faking ourselves out does no good, right? Psychologically, we all, if you're long gold, you want it to go up. If you're long silver, obviously we do, but it kind of fools us. And I'm someone who doesn't want my head in the sand, right? I think a lot of you guys are like that. If you follow me, is like, you want to know the truth, even if it's not in line with what we all want to happen in the precious metals or in any investment, frankly. But it is what it is, right? All right. So that's where we are on gold. Remember, the idea here is if we had to project out, let's just say we kind of come down here, we get a little bounce, we come down in this range, we bottom out, then it's going to take a little bit of time. We'd have to obviously stretch this out. But the idea is eventually, I do think if we stretch this out, that gold eventually does, again, and we could draw this. I mean, and I'm not saying it's going to play out just like this, but we hit, we break, and then we get that bigger breakout to the upside. And again, my guess is we don't break out of this till at least 2027, out of this downsloping parallel. And essentially what we need to think, you need to think at least there's a period of consolidation that probably is a year long, right? After this mega move up, it's got to consolidate. At this point, you haven't consolidated and had a drawdown big enough to wash out the weak hands. But again, at some point a year out from now, and we haven't broken out and gold's kind of gone to sleep, then I could see that flushing out those weak hands, the speculative hands, and then gold actually does break out at that point.
The key is not to confuse short-term weakness with a failed bull market. Gold and silver can bottom before the fundamentals fully turn, especially when rate hike fears are already priced in. If the 2-year yield peaks, or if longer-term yields begin rising faster, the pressure on metals could ease quickly. Until then, patience matters more than chasing every bounce. Sentiment is becoming a more constructive signal. Fund managers are no longer treating gold as heavily overvalued. GLD flows have fallen sharply, and options hedging shows a high level of fear. These readings often appear near meaningful lows in a secular advance. With gold allocations still below past bull market peaks, the next durable rebound could attract far more capital than the current market expects. That creates room for a larger move once fear turns into renewed institutional demand across global portfolios. Now, let's get back to the interview.
We look at silver real quick. Here we go. Let's go a little bit of a zoom in here. So here we had our support for 66 to 64. Notice why that support is there. We had our low pivot here, our high to our short-term low, our lower high and our lower low, right? And then we still, even though we wicked down or tailed down here, we had a lower low put in, we still recovered and stayed above. And here, notice how low, lower low, and here we had an equal low, but we had the lowest close. And so it's still showing weakness, even though we didn't technically make a lower low on this drop. You got the lowest close on a daily candle since the bull moved to the upside. And that is just something to pay attention to. It's not the end, not the end all be all, but just a little bit of a nuanced note. Now, if we rally, max rally would be up here. I doubt it gets there. My thought process is you more get kind of a move up to this area. Notice this low and this area right here. It's also, if you extend it out, look at how it goes right into here. And then even more so right through there, right? So this is going to be now right around 71, 72 is going to be near-term resistance. And that'll be what's telling, do we go up and kind of tag it, and then we finally break down, and then we go to 54. And 54 is obvious here just because it's a high pivot and a high pivot. Now, do I think it stops there? No, at some point, I think it has to go back to 50. And I think, it's so interesting because I've been saying, the reason why 50 is so intriguing is that it was the high in 1980. It was the high in 2011, basically, give or take. And a lot of comments, and I read the comments, guys, again, and that's why I say I appreciate all the kind words, even if I can't respond to each and every one of them. I do quickly glance through them and read them, and it really motivates me, the kindness from all of you. But the key here is that people write and they're like, well, the dollar isn't worth the same. Silver's not the same based on inflation as it was in 1980 nor in 2011. Absolutely right. But what is the same, and the reason why you see these retraces on charts, is because human emotion. So short term, things get out of whack. It's one of the reasons why if I thought fair value was $50, I probably wouldn't buy it. I don't like buying at fair value. I like buying at discounts. So I agree with that it's not the same. But when you have emotion in investors and they see it getting down to 50, they panic, they sell, which causes that wick down or that tail down piercing $50. And it's oversold at that point because you're right. It's not the same. We have higher inflation, et cetera. Inflation really silver should be way higher. But that's where it becomes a deal. And that's what I'm always looking for in terms of buying, right? So those are some of the keys here on the charts of silver. All right. So again, 54 for support. If it gets through there. And listen, if we can get above 71, 72, then you actually have a shot at getting back to this trend line and maybe even retesting here. But let's first see what happens here. Like, which way breaks? Does 64 break or does 72 break? One or the other. That's what we're watching.
Sentiment revolves around money, where the money has moved, how much the money has moved, how much buying power or selling power is left in the market. And so when you get a big correction like we've had, that's where sentiment becomes really useful. It tells us how much more selling pressure is left in the market. And so this data here is based on the Bank of America Global Fund Manager Survey. So this chart shows the net percentage of fund managers who think gold is overvalued. Now, when it's down here, it's negative. They think gold's undervalued. So this is where we are right now. I think it's a net 2% who actually think gold is overvalued. Now, we go back here 3-4 months ago, look how high it was. And so, by the way, this I think was probably January or February, a month or two before gold broke out of its 13-year long cup and handle pattern. And now this is almost at a 2.5-year low. So this is the lowest since gold broke out of the 13-year cup and handle pattern. We could go back and look when gold was in a secular bull. There's not a ton of history, but it was in a secular bull until you could call it the end of 2012. But you can go back here, I believe late 2008, early 2009. So these types of readings, they correspond with significant lows in a secular bull market. So that's where we're headed to in the next month or so. Okay, let's look at more sentiment indicators. And these are new, by the way. The net fund flow into, so are investors putting their money into GLD, or are they selling GLD and taking it out? And so that data is actually smoothed by a 100-day moving average down here. So this is a 100-day moving average of fund flows. Look at where this has come just in the last month or two. I mean, this is plunged, okay? This is down here at this mark here at the 2022 low right there, down here at the end of 2020, that was also a low. So this is very encouraging for gold with respect to sentiment. Here's another one here. This is the GLD 6-month put call skew. And so the skew actually measures the cost of betting that the market is going to go down or buying a hedge because you're worried that the market is going to go down. And so when this reading is up here, that's evidence of more bearish sentiment. And look at where we are. This is at basically a 9 or 10-year high. You have to understand, people, the sentiment indicators are telling us gold is getting really, really close to being all sold out. Okay, there's not tons of people left that have to panic out of the market. That's already happened. So sentiment is telling us there's not that much more downside in gold. Okay, and I posted this last week, but I just want to reiterate, in the big picture, there's still a very low allocation to gold, despite the huge move that gold and precious metals have had the last 2 years. One of my bread and butter indicators, the implied allocation to gold. All the money in gold ETFs, buying all the money in all ETFs. This is where it is for gold. I mean, look, this thing has not broken out yet. It's not moved like that. It's down here below 2%. Again, 2008, 7%. The peak in 2011, over 8%. It's below 2% now. And then consider this again. The JP Morgan Global Family Office Report covers 333 family offices from 30 countries. The average net worth, 1.6 billion. Percent don't own any gold. Okay, the average allocation of the 28% who do, 0.9%. People, when you look at these things, I'm telling you, when gold makes its next move and the stock market has its next bear market, you're going to see gold go to 10,000. During that move, and eventually much higher after that. And so we have to understand what we're coming to. This is a significant low in the gold market, the silver market as well, and also for the stocks, and it's going to be an incredible buying opportunity.
Silver remains the more volatile part of the setup, so discipline is essential. A move above the $71 to $72 resistance area would improve the short-term picture and open the door to a retest of higher trendline levels. But if support around $64 breaks, the market could slide toward $54 and possibly $50, where emotion, forced selling, and old breakout memories may create a better discount. That level should not be seen as failure. It could be the kind of oversold reset that prepares the next advance. The broader prediction is still bullish. Gold may need months of consolidation, perhaps not breaking clearly from its corrective channel until 2027. Once the stock market enters another bear phase and investors rotate toward safety, gold has a realistic path toward $10,000 and eventually higher. Silver and mining shares could benefit sharply after the final low forms. But the best strategy is to buy weakness carefully, hold strong positions, and avoid being shaken out by normal volatility before the larger move begins. The cleanest opportunity is likely to appear when price feels uncomfortable, headlines turn negative, and long-term buyers regain control after the final shakeout ends. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.